Okay, we are recording. Hello there, everybody. I am doing this recorded lecture to get some practice with the journal entries that we've been doing in chapter 3. Since we're not meeting in person today, again, I wanted us to just get a little bit more practice with these journal entries. And remember, we've been going through those steps of the accounting cycle. So step 1, analyze the transactions. Step 2, journalize the transactions. Step 3, post the transactions to the T accounts. And then step 4, prepare the unadjusted trial balance. So again, I picked out an exercise since we're not meeting in person that we can go through and just get practice, a little bit more practice with these journal entries. So I will also, once I finish this recorded lecture, post this Excel file into Brightspace so that we all have access to it as well. Let me share my screen with you and get this pulled up. Okay, so here, and let me click out of here so I'm not staring at myself the whole time. So here we've got several transactions. If you see, we can kind of scroll down, however many we have, some different transactions that we're doing here for Aerocell Engineering. So Aerocell Engineering completed the following transactions during the month of June. So our first one here, letter A, Jenna Aerocell, the owner, invested $100,000 cash, office equipment with a value of $5,000 and $60,000 of drafting equipment to launch the company. So before we start on our entries, let's just remind ourselves of that acronym that we've been referring back to in class, and that acronym that we're trying to, memorize, hopefully, to help us know, which accounts increase with the debit, which accounts increase with the credit, right? So member AID, ADE. So this is our assets, drawings or owner withdraws, and expenses. And these all increase with a debit, decrease with the credit, right? We've seen that several times on the board now. And then liquor, LCR, which are our liabilities, capital, and revenue. And these are opposite signs to assets, drawings, and expenses. So these decrease with a debit, increase with the credit, right? So you guys have seen that. We've written that on the board. You've seen that because I know that we all read chapter 3, right? And so we can get some practice with this. We've got several transactions picked out here we can get some practice with. So in this case, the owner's investing 3 assets right here on letter A, because we're investing $100,000 in cash, office equipment with a value of $5,000, and $60,000 of drafting equipment, right? So we want to debit the assets. Assets increase with a debit. And then we're going to credit owner capital for the entire amount. So we'd have debit cash, 100,000. Debit office equipment, 5,000. Debit drafting equipment, 60,000. And then again, we credit owner capital for the entire amount of the investment, 165,000 is what that journal entry would look like. All right, the next one, letter B. The company purchased land worth $49,000 for an office by paying $63,000 in cash and signing a long-term note payable for $42,700. So now we're purchasing a land asset. So again, assets increase with the debit. We put a down payment of cash, 6,300. Cash is an asset. Cash is decreasing with a credit. And then also we took out this loan, this long-term note payable. That's a liability. Liabilities increase with the credit. So this one we would debit land 49,000. Credit cash for the amount of cash down payment, and then credit notes payable for the amount of the loan, 42,700. So that's how much that we still owe on it. All right, letter C. The company purchased a portable building with 55,000 cash and moved it onto the land acquired in B. All right, so now we've got two assets being impacted, right? We've purchased a building. A building is an asset. The building asset is going to increase with a debit. And then we paid cash. Again, cash is an asset. Cash is going to decrease with the credit. So this one we would have debit building 55,000, credit 50,000. And we're not going to complete all of the T accounts in this problem. We're just doing this problem for some more practice with the journal entries. But just so our brains are kind of thinking this way, I wanted to just show you what this would look like so far in our cash account, right? So if we're thinking about our T account or our ledger account, I'm just going to make one real quick here for cash, and I keep getting off of it here. We need, okay, so if we have our T account for cash, all right. And so just with these first three transactions, first we invested the 100,000 cash, we debited cash 100,000 in letter A. Letter B, we put a down payment on the land, so we credited cash 6,300. And then letter C, we purchased the building 55,000 cash, so we credited cash. So at this point, we would have what in our cash account equals our 100,000 initial investment minus the 6,300 that we put down on the land, minus the 55,000 that we used to purchase the building. At this point, our cash account would have 38,700, right? Just after those first three transactions. And again, we're not doing the T accounts for every transaction. In this case, I just kind of wanted to remind us of where we're going with that, because when we are together again on Monday, we will complete problem 3.3a, which will be using and updating the T accounts in that problem. So anyway, letter D, the company paid 3,000 cash for the premium on an 18-month insurance policy. So again, we've prepaid this expense, right? When we purchase prepaid insurance, that's a type of prepaid expense. So we've prepaid this expense for 18 months. And when we prepay an expense like this, this is an asset to us, right? So remember, we call this one prepaid insurance. So we're debiting the prepaid insurance asset for 3,000. We're crediting for 3,000. All right. The next one here, letter E. The company completed and delivered a set of plans for a client and collected 6,200 cash. So remember, we are an engineering company, and now we've just completed and delivered a set of plans for clients. So we've earned revenue. And the client paid cash, 6,200. So again, cash is an asset, cash increases with the debit, and then revenue, as we see here, increases with a credit, right? So this one we'd have debit, cash, 6,200, credit, revenue, 6,200 is what that one would look like. Okay, let me see. I can select this, bring it down a little bit for us so we can keep bringing it down as we're going so we can keep looking at it. All right, so then let's look at the next one, letter F. So the company purchased 2,000 of office supplies on account from Office Depot. Okay, so remember that on account means that we did not pay cash. We could think about it like we purchased these supplies on our Office Depot credit card, for example, right? On account. We still owe for it. We created a debt. We created a liability. So supplies are an asset. Supplies are going up with a debit, but now we owe for it. So our liability, accounts payable, is going up with a credit. So this is a debit, supplies for 3,000. Oh, excuse me, 2,000. Hold on, Jess. 2,000. And then credit, accounts payable, 2,000 is what that one would look like. All right. Okay, so letter G here, if you see letter G, if we scroll back up real quick, letter G is very similar to letter B, right? So letter B, we were purchasing an asset, land asset in that case. We put a cash down payment and then we took out a loan for the rest. Letter G is very similar to that, except for we're buying drafting equipment instead of land, right? So this one, letter G, it says the company purchased 20,000 of additional drafting equipment by paying 9,500 cash and signing a long-term note payable for 10,500. So again, drafting equipment, that's an asset. That's going to increase with a debit. So we're going to be debiting drafting equipment. Cash is also an asset. And we're putting 9,500 down on this equipment. So cash is going down. We're crediting cash. And then again, we took out a loan for the remaining balance, 10,500. That's a liability. So we're going to be crediting the liability. So this would be debit drafting equipment. 20,000. Crediting cash for the amount of cash that we put down, 9,500. And then crediting notes payable for the amount that we still owe, 10,500 is what that one would look like. Okay, letter H, the company completed 14,000 of engineering services for a client. This amount is to be received in 30 days. So remember, up here on letter E, we had this revenue transaction, but in that case, the customers paid cash, right? Now on letter H, we've got this revenue transaction. We've earned 14,000 worth of revenue, but the amount will not be received for 30 days. So remember, we call that accounts receivable. So this is an amount that we expect to receive in the future. So that's accounts receivable. Accounts receivable is an asset. So asset increases with a debit. So we're debiting accounts receivable for 14,000, crediting revenue. 14,000. Again, we completed engineering services for clients. So we've earned the revenue. We just haven't collected it yet. So it's going into accounts receivable until the customer pays us the money, right? Letter I, the company purchased 1,150 of additional office equipment on credit. Okay. So, office equipment is an asset. Assets increase with a debit. So we're going to be debiting office equipment. And again, that on credit, that means that we did not pay cash. We basically could look at it as we used our credit card, right? We created a debt. And so that's a liability, accounts payable. So we're debiting office equipment. 1,150. Crediting accounts payable. Let me pull this down a little bit more for us, so we can keep looking at it as we're going. All right. Letter J. The company completed engineering services for 22,000 on credit. Again, that on credit means we did not collect cash from the customer. They still owe us. So in fact, this one is going to look exactly like letter H, right? Same thing with letter H. We completed services for a client. We are not going to get paid for 30 days. That's the same thing happening here on letter G, or excuse me, letter J. We completed engineering services for a client, but they have not paid yet. So that's accounts receivable. Accounts receivable is an asset that increases with the debit. And then this is us earning revenue, providing engineering services. Revenue increases with the credit. So this is a debit, accounts receivable. 22,000. Credit our revenue account. 22,000 is what that one would look. Okay, letter K. The company received a bill for rent of equipment that was used on a recently completed job. The 1,333 rent costs must be paid within 30 days. So just like we talked about in class, if we had paid the bill, it would explicitly state it, right? It would say the company received and paid a bill for rent or whatever the, whatever the expense is, right? But in this case, it's telling us that we just received the bill. We have to pay it within 30 days. So again, this is accounts payable, right? So this is an expense. We would probably call it equipment rental expense, some type of expense. And then we're going to credit accounts payable. Remember, expenses increase with a debit. So we would debit equipment rental expense. 1,333. We would credit accounts payable. 1,333 is what that one would look like. Okay, letter L. The company collected 7,000 cash in partial payment from the client described in transaction H. So let's scroll back up here. Back here, transaction H. This is where we provided engineering services for a client for 14,000. We gave them an invoice or we sent them a bill for the 14,000. And now they're making a payment on it, right? So when we sent them the bill or the invoice, we debited accounts receivable. Now that they're making a payment on it, we have to do the opposite to accounts receivable because again, they're making a payment on their bill. they will no longer owe us 14,000 because they're making a payment, right? So accounts receivables an asset, assets decrease with a credit, and they're paying us cash. Cash is an asset that increases with the debit. So this would be debit cash for 7,000, credit accounts receivable. Again, now they no longer owe us 14,000. They just made a payment of 7,000, so now they only owe us another 7,000, right? They basically paid half of what they owed us. Okay, bring this down a little bit more so we can keep looking at it as we're going here. Okay, letter M, the company paid 1,200 cash for wages to a drafting assistant. So again, this is an expense. In this case, wage expense. Expenses increase with a debit. So we're debiting the expense. And then we paid this employee cash. Cash is an asset. Cash decreases with the credit. So this one would be debit, wage expense for 1,200, credit. Okay. Letter N, the company paid 1,150 cash to settle the account payable created in transaction I. All right, let's scroll back up. What was transaction I? So here was transaction I. So transaction I, we purchased this office equipment on credit. Now we're paying it off. So again, when we created the debt, we credited accounts payable. Now that we're paying it off, we have to do the opposite to it. So we're going to have to debit accounts payable, and we're paying cash. Cash is an asset. Cash decreases with a credit, right? So we're debiting accounts payable, 1,150, crediting cash is what that one would look like. Okay, letter O. The company paid $925 cash for minor maintenance of its drafting equipment. So this is an expense. We'd probably call it maintenance expense. And again, expenses increase with a debit. So we're going to debit the expense, and we paid cash for it, right? It explicitly states we paid 925 cash. Cash is an asset. Cash decreases with a credit. So this would be debit, maintenance expense, 925, credit, cash, 925. That's what that one would look like. Okay, letter P, Jenna Aerosel, remember that's the owner, withdrew 9,480 cash from the company for personal use. So this is an owner drawing. Owner drawings increase with a debit, and the owner's withdrawing cash. Cash is an asset. Assets decrease with a credit. So this would be debit, owner drawing. We also could call it withdrawals, right? Withdrawing cash from the company, credit. Is what that one would look like. Okay. Keep going here. Let me move my little acronym dealio down so we can keep looking at it as we're going. This next one, though, this is a repeat. Remember, we already paid this drafting assistant one time, so now we're paying them again. So it says the company paid $1,200 cash for wages to a drafting assistant. So again, this is an expense, wage expense. And so expenses increase with the debit. We're debiting the expense. And we paid cash. Cash is an asset. Cash decreases with a credit. So we're crediting cash. So we've got debit, wage expense, 1,200, credit, cash, 100. And we did that one already. If we scroll back up, we paid them back here on transaction M, right? We did that same transaction. So they're, it's the next payday or whatever. They're getting paid again, right? Okay, letter R. The company paid $2,500 cash for advertisements on the web during June. Okay, so this is an expense, advertising expense, right? So expenses increase with a debit. We're debiting advertising expense. And then it explicitly states that we paid cash. And so cash is an asset, cash decreases with a credit. So we're crediting cash. So debit, advertising expense, 2,500, credit, 2,500 is what that one would look like. Okay. Letter S. The company paid $500 cash for this month's utility bill. So again, this is an expense, utility expense. Expenses increase with a debit. And so we're debiting the expense, and it's explicitly stating that we paid cash. So we're crediting cash. So this is debit, utility expense, 500, credit, cash. Okie dokie. Letter T. Oh, let me pull my little guide down here. We just got a couple left. Two more. Okay, letter T. The company completed engineering services for another client and collected 12,000 cash. So cash is an asset. Cash is increasing with the debit. And this is us earning revenue, right? Because we've completed engineering services for the client. And so revenue is increasing with the credit, right? So this would be debit, cash, 12,000, credit, 12,000. Okay. And last, but not least, I don't think, let's see, did we have any transactions that were under 300? Let me scroll back up here. No, we did not. So actually, this one is last and least, right? Because this is our lowest transaction amount that we've had so far. So the company received a bill for 300 for this month's telephone bill. So again, it doesn't tell us we paid it. It just says that we received the bill. And so we've got the expense going up, telephone expense. Expenses increase with the debit, but we haven't paid it yet. So this is our accounts payable. The liability is increasing with the credit. So this would be debit, telephone expense, 300 credit accounts payable. 300. Okay, so several transactions there that we got practice with that we can look at together. Remember, and I'm going to save this file and I'm going to post it into Brightspace so that we have it in Brightspace as well. We've just completed, and I'll write them down here again for you. So remember step 1 of the accounting cycle, analyze transactions. And that's just really reading the transaction, determining which accounts are going to be impacted. What do we need to debit? What do we need to credit, right? Step 2, which we just have done as well, journalize transactions. All right, we've just gotten some more practice with that. Step 3, post transactions to the T accounts or the ledger accounts. Hot dog. I forgot my I. Post transactions to T accounts. And then step 4, prepare that first trial balance, the unadjusted trial balance, right? And so we've already gotten practice with step 3, with step 4. We actually got practice with step 3 in chapter 2. And we got practice with step 4 in chapter 2 as well. But chapter 3 now we're focusing on learning these journal entries, completing these journal entries. So I wanted to get a little bit more practice with that. And again, when we're back in class together on Monday, we will do problem 3.3b, which you can see down here. I've already got an Excel file for. And so, you know, when we're back in class on Monday, we'll do problem 3.3b together, where we'll do the journal entries, we'll post the transactions to the T accounts, and we'll prepare the first trial balance. So that's where we're going with it. Hopefully that was helpful to you guys. Let me stop sharing my screen. Hello. I'm really close because I'm writing on the screen. But as always, if you guys have any questions, you know where to find me, and I will see you soon. Bye-bye.